Brought to you by Standard Bank, the bank for entrepreneurs.
A SME business that's involved in the transportation sector, and that could be the transport of their own product from a central warehouse to distributors or to the market. They need to consider the impact and the responsibility of who is carrying the risk for insurance. So is it a high value good? Alcohol and tobacco are typical examples that stand out, where they do attract a lot of attention. Unmarked vehicles would be advisable rather than a nicely branded vehicle so everyone knows what you're transporting. So it's important to look at the aspects and what product is being covered. Can they take the risk of insuring for the loss of those goods by way of theft, spillage, contamination in respect of chemicals overturning on the vehicle? If it's coal, for example, it's a very low hazardous type of product, so to clean that up is quite easy with regards to a front end loader, and you load it back onto the vehicle. However, chemicals is a very different scenario where there are obligations and legal implications of a spillage and contamination. There could be water damage, soil damage, so there's a lot of factors to consider by the business. In respect of materials that can easily be cleaned up, yes, there's a less of a liability exposure, but in respect of chemicals, there's a huge onus and a legal requirement to make sure that that liability cover is in place. With regards to warehousing, SMEs should really consider their obligation in terms of the storage of those goods. Do they own those goods? Are they on consignment? Consignment would be when those goods are lent to them or forwarded to them for onward distribution. So there may be a legal ownership of those goods, but there is, in terms of bailee responsibilities, they are responsible for goods under their custody and control. So they need to look at that. They need to also consider, are their facilities adequate to store those goods? So if it's palletized food products, that's one thing, but are they looking at storing paints and solvents, for example, which requires a totally different storage facility and has to be separated from premises. So I think the danger is that having a general warehouse and putting everything into that warehouse and actually not segregating products by type has its own risks. It also can result in fires, for example, and especially with solvents and stacking of those warehouses. So insurers do tend to look at the warehousing risk in a rather strict manner, because what you quite often find is housekeeping is directly related to the incidence of fire. So poor housekeeping, a higher fire risk, good housekeeping, generally those businesses run a lot cleaner. And from an underwriting point of view, when they walk on site and do surveys, they also look at housekeeping and then saying, well, are the areas clearly defined? Are the corridors clear? Are the sprinkler and fire extinguishers adequately serviced? And is there evidence of that? So a lot of those pointers with regards to running a clean facility does point to the risk. Also, when you start looking at the fleet, and are those fleets well managed? Is there one vehicle, which is a totally different scenario to having 4 or 5 vehicles? And again, are those vehicles owned, or are they leased, or is there a scheme where a third-party driver is operating their own vehicle and they paid for deliveries? So you don't always have to capitalize the business with regards to expensive items such as vehicles. Vehicles can be outsourced, and you don't necessarily need to own them to control the distribution channel.
Brought to you by Standard Bank, the bank for entrepreneurs. Standard Bank. Moving forward.